Welcome to the recorded version of Women in Retirement Security, Challenges and Solutions, brought to you by the American Society on Aging and a generous sponsorship from the National Reverse Mortgage Lenders Association.
All right, we have a couple different presenters today, and we're very excited to have them here with us today. Lara Hinz is Director of Programs at WISER, which is the Women's Institute for a Secure Retirement. WISER is a nonprofit that works to help women, educators, and policymakers understand the important issues surrounding women's retirement income. Hinz is also Deputy Director of the National Resource Center on Women in Retirement Planning, operated by WISER and funded by the U.S. Administration on Aging. Lorraine Geraci has more than 12 years' experience in the reverse mortgage industry. She has trained more than 1,000 reverse mortgage professionals through instructor-led classroom training and national webinar-based training. She currently oversees the Learning and Development Division of Finance of America Reverse. Jocelyn Wright is the American College State Farm Chair for Women in Financial Services and Assistant Professor of Women's Studies. She's the founder and managing partner of the Ascension Group. So we've got a great list of presenters here today with us that we're very excited to have here. And opening today's presentation with a couple remarks and a few things for you is going to be Jenny Warwa from the National Reverse Mortgage Lending Association. So over to you, Jenny. Thank you very much for being here.
Well, thank you so much, and thank you to all of our participants today. We hope that you'll find the information that we present useful and that this webinar is a helpful way for you to speak with older adults and especially women who are nearing retirement age, who are currently retired, about strategies to support their current and future financial needs. At the National Reverse Mortgage Lenders Association, we seek to educate consumers about the pros and cons of a financial tool that enables older homeowners to tap a portion of their home's equity to supplement retirement savings. We also train our members to be sensitive to clients' needs. And above all, we encourage all adults to plan for longevity, not just 65 to 75, but 85, 90, and even 100 years of age. For consumers considering reverse mortgage, NRMLA has developed several consumer guides that are available on our consumer education website, reversemortgage.org. These 3 guides are free to download, and they encourage people to consider 7 questions about reverse mortgages before moving towards an application. We also have tools for people who have just closed on a reverse mortgage loan, and a guide for people who are ready to repay their loan. And as I said, we're very happy to be working with ASA on this presentation, and we're excited to present Lara, Jocelyn, and Lorraine on Women in Retirement Security Challenges and Solutions. Thanks.
Great. Thank you, Jenny, and thank you all for being a part of the webinar today. My name is Lara Hinz with WISER, and I know you heard a little bit about WISER in my bio, but for those not familiar, I'll just add that our mission is primarily to educate women about some of the unique challenges they face when planning and preparing for retirement, and then arm them with the information, tools, and resources that can really help them take control over their financial lives. So we do this through publications and trainings and workshops, and through opportunities like this one today to share information and ideas that can help women build lifelong security. So again, I want to thank you for having us as a part of this call today. There we go. All right, so why do we focus on women? Why are we specifically talking about women today? And there are financial challenges we all face, but the fact is that there are unique issues that women experience throughout their lives that can make financial security and retirement even more challenging. So first, women are more likely to earn less over the course of their lifetime. You can see there that the median incomes for older women and men on the screen, and then of course the pay gap still exists, where women overall continue to earn only about 79 cents on the dollar compared to men. So when you break that down by race, minority women, women of color are earning even less on the dollar. Women are also more likely to take time away from work for caregiving, other family responsibilities. 60% of caregivers in the U.S. today are still women. Women are also twice as likely as men to work part-time, and this means, of course, not only less income, but often less access to other workplace benefits like health and retirement benefits. And then all of which ultimately leads to women having less in savings and pensions. Finally, women also live longer than men on average, which means they also have a greater likelihood of living alone at some point. And in fact, 47% of women over the age of 65 are single, whether that's due to being widowed, divorced, or never having been married, compared to only 18% of men. So living longer can certainly be great for many reasons, but it does come with some risks. So if we look more closely at this longevity risk, basically the longer you live, the more you risk the negative effects of inflation, death of a spouse, increasing health care costs, all of which can ultimately lead to outliving your assets and ending up in poverty in your later years. A statistic that always gets me, too, is that when we look at the population of those who are 85 and older, women make up about 71% of that population, and that's huge. And this is the age group that's most likely to end up running out of money. And I don't mean to get us started with a lot of depressing statistics, but I think the key point and what we really want to drive home today is that in this day and age, we're looking at periods of retirement that now last 20, 25 years or longer. And many women drastically underestimate how long they'll live and how much of a financial risk this poses. So we really need to be thinking beyond just a few years down the road and really think long-term when it comes to our finances. Each of the presenters I know today is going to touch on this in kind of a different way. I'm going to focus on two life events that can dramatically impact a woman's long-term financial security, and those are divorce and widowhood. So first we'll look at widowhood. For most married women, widowhood is going to be an inevitable part of their journey. Women are 4 times more likely than men to outlive their spouses. And even though we often hear the statistic that women live 3 to 5 years longer than men on average, the reality is that periods of widowhood lasting 15 years or more is not uncommon. And I'm sure we can all think of examples in our own lives of women we've known who have well outlived their spouse. And there is a financial impact to this. There's a decline in standard of living, and it's likely more often acute for women following the death of a spouse. Household income generally declines by about 40% due to changes in Social Security benefits, loss of spouse's retirement income or earnings, and yet expenses remain relatively the same, right? You still have to pay the electric bill and the cable bill, rent or property taxes. And in fact, one study found that 1 in 8 widows needed to move to less expensive housing, which is also why talking about home equity is so important, and I know Lorraine's going to touch on that a little bit later. And yet, so despite what we know about women in widowhood, if couples do any financial planning, they usually just plan for their years as a couple. I'll add to that when we talk about some of these statistics, it's about women being more likely to outlive their male spouses. But even in same-sex couples, chances are you will not die at the same time, right? One partner is still going to outlive the other, and you'll need to be planning for that time when one of you will likely be on your own. So how can we be better prepared for the possibility of widowhood, or how can we help others going through this experience? A good first step is for you and your spouse to ask each other, okay, so if I wasn't around, what would you struggle with? And this can be a difficult conversation to have, but it's a really important one. By asking each other this question, you can really start to identify where you might need help or what other information you might need. So, for example, would you struggle with knowing what bills to pay or how to make those payments? Maybe you aren't sure how to access money in your savings accounts, those sorts of things. And then it's also a smart idea for each partner to make an after I'm gone file. You can certainly call it something else if that sounds too morbid. But this would be an electronic or hard copy file that you keep somewhere safe. And it should include important financial documents, things like retirement account statements, banking information, as well as any insurance documents or wills, power of attorney, that sort of thing. And then also make sure to include login information and passwords to your online account. So much of what we do today is online, and it's hard, for ourselves individually to keep track of all of these passwords, but we want to make sure that those are in an organized place for our spouse if something happens to us. Certainly if you end up scrambling to collect the documents at the time when your spouse does die, when you're in mourning, it's going to be doubly challenging, so it's really better to do this before you need the information. If your partner's been the one handling your finances, now is also the time to ask them to walk you through everything so that you kind of have a general idea. And then next, you want to understand each other's retirement plans and what your rights are as a spouse under those plans if your partner dies, so that you can plan accordingly. And make sure you know who to contact at that plan. That can sort of be part of your after I'm gone file that you make. Next, if your family has a financial advisor, you really want to make sure you also have a relationship with that person. So don't just have your spouse be the one who talks to the advisor or goes or meets with them. You might be the sole decision maker at some point again, so you want to know that advisor well before that time comes. And I know Jocelyn will also talk a little bit more about this important topic. And then finally, as you learn about and go through these steps, talk with your friends or encourage your friends who are going through this to talk about these issues too. I know in Wiser's workshops, some of the most productive conversations we have are really when the women in the group kind of open up. They share their own experiences, maybe even their own mistakes that others can learn from, things that have worked for them, and it can really make it feel a little less overwhelming when you know that others are going through the same thing. So I think the more we can be doing to provide opportunities and encourage women to open up and share these experiences, the better we are. So next we're going to look at divorce. I know there was a news article recently that got picked up in a lot of places that actually talked about kind of how divorce is a real threat to retirement security. And it was even more so for women due to many of the challenges that we've already mentioned. And it's a very emotional and vulnerable time, but that makes it all the more important to want to sort of do your due diligence before a divorce is finalized. Or if you know someone who's going through a divorce, make sure they have this information. Any mistakes made during this critical time really can have long-lasting financial consequences. So first, you want to find out what your rights are to your spouse's pensions, and states are going to have some different rules about this. So one resource you can use to get started is something called divorcesource.com. You can just sort of click on states, find out specifically what the rules are in your state for property division, that sort of a thing. And then check if your spouse has more than one pension from their current job or previous jobs. And I will also add, this is why it's a really good thing if you were involved in your family finances previously, because once you're in a divorce negotiation, the spouse may not be as cooperative and forthcoming with this kind of information. So being involved early, that's one more plug for getting involved in your finances. And then also, don't assume that your lawyer is going to have all of the answers or ask all the right questions. You really need to be actively involved in this process. If you have questions, you want to get them answered before your divorce is final, even if you have to be the one to collect some of that information. It can be really frustrating at times, but you need to be persistent. And then this last point is key. You want to strive to retain your pension or your rights to your spouse's pension. Many women will often give up portions of their own retirement funds or their rights to their spouses in order to keep the house, for example. But this can be a really costly mistake. Retirement funds, they can continue to earn interest and provide actual income down the road, but the house is still going to be an expense. It doesn't provide readily available liquid assets. So you really want to consider those retirement plans and pensions some of the most valuable assets in the negotiations. Don't give them up too easily. And then here's a very important fact to know in a divorce. The divorce law in just about every state recognizes retirement benefits as a joint asset if they were earned during the marriage, but they're not automatically split in a divorce. So just like other marital assets, a divorce court judge or an agreement between you and your spouse, that's what actually divides those benefits. So once you agree on how those benefits will be divided, you also need to get a court order called a Qualified Domestic Relations Order, or a QDRO. And this is something a lot of people don't know when they're going through this process. But what this does is it establishes your legal right to receive a portion of your ex's retirement payouts. It's usually written by one of the couple's attorneys, and then it orders the retirement plan to pay you a specified share of the benefits based on your divorce agreement. So again, let me just emphasize, this is a really critical point. You want to have all of the information about your spouse's retirement benefits before the divorce, and you need to include that division of benefits in the divorce documents. It's pretty much nearly impossible to go back to court and ask for a share of those benefits once the divorce has been finalized. And this is something we hear a lot about from women who contact us at Wiser. It's maybe been 10, 15 years since they're divorced. Now their ex is retiring, they're wondering if they have rights to that pension he's getting. And unfortunately, we usually have to break the bad news that it's probably too late. So before I wrap up, I just want to quickly make you aware of some of the resources on divorce and widowhood that you can access on Wiser's website, which is wiserwomen.org. These are certainly complicated issues. Obviously, we only touched on a few key things today, but more information is available if you need it, or if you want to share these resources with your networks or anyone else you might know, they're certainly there and available to you. And as was mentioned earlier too, Wiser also operates the National Resource Center on Women and Retirement Planning. And through that center, we're able to provide lots of resources, not just on these topics, but on many other issues related to retirement planning. So you can check them out on our website and just know that they're there if you need them or if you want to share them within your organizations and other networks. So before I turn it over, I'm going to put a polling question up. So Steve, if we can get that up on the screen for everyone. We're talking today about financial and retirement planning. And so I kind of wanted to get everyone on the call thinking about sort of their own current financial situation and what would the next steps be that would be most useful for you right now. And when you look at this list, maybe one or more of them applies, but think about what the top action item would be that would be most helpful for you in your financial planning. So maybe it's learning more about saving and investing or investments that you have, figuring out how much money you'll actually need when you retire, speaking with a financial planner or advisor. For some, maybe it's managing credit and debt, or talking with a spouse or partner about our financial plan. So go ahead and select one of those, and then we'll give it a few seconds before we pull up the poll and see where we're at. Okay, also it looks like we have kind of a tie here between figuring out how much we'll actually need in retirement and talking with my spouse or partner about our financial plan. And that's really, it's a good point about figuring out how much I'll need, because I think so many times, you know, we often overlook that step. We're so busy thinking about how we have to save. We know we have to save for retirement, but we don't always take the time to kind of figure out or try and understand exactly how much money we're going to need. So it's kind of great to see folks thinking that that might be an action step they need to take. And the good thing is there's lots of really good online tools and calculators, too, that can make this pretty easy. On Wiser's website, we link to some of them if you want to check them out. But now I'll turn it over to our next presenter, Jocelyn Wright, and we'll go from there. Thank you, everyone.
Great. Well, thank you very much, Lara. And so what I'm going to be talking about is the process of financial planning and what that means. Again, my name is Jocelyn Wright, and I am the chair and director of the American College State Farm Center for Women in Financial Services. And what we focus on is getting more women into the financial services industry, both as advisors and in key leadership roles. And while we don't have a direct route to the consumer, we do work with financial advisors in making sure that they are meeting the needs of their female clients and making sure that they're financially empowered. So to start, let's just talk about what is financial planning. You will find many different definitions of financial planning, but for the sake of this presentation, we are going to define financial planning as the process of identifying one's financial goals and objectives and developing a plan to assist in achieving those various goals. In financial planning, there are basically 6 areas, and we're going to touch on them briefly as well. So the first would be cash flow management. You would consider this sort of the baseline or foundation of any financial plan. So in this stage, you and your planner are going to look at what your various inflows and outflows are. So this is where you're going to identify your income and expenses, and also this is where the dreaded B word or budget comes into play. So making sure that you have enough income to cover your expenses, and if not, what are certain things that you need to do in order to minimize the gap that exists. Next is going to be risk management. This is where we're also calling this either insurance planning or protection planning. So in this area of financial planning, your planner is going to look at either minimizing risk to you or transferring any risk that you might have from a liability standpoint to a third party or insurance company. So here we're looking at your various insurances, medical, disability, life, long-term care, as well as your homeowners and auto insurance. The third step is investment planning. So this is when we're beginning to have a conversation about wealth accumulation. So what are the proper investment vehicles or strategy that you need to focus your assets on based on whatever your goals and objectives are, as well as the particular level of risk that you're willing to take. The fourth stage is tax planning, and of course we all know that the only certainties in life are death and taxes, and so no one can avoid it. So in this area, you're working with your planner to find out, and to just make sure you're paying the taxes that you are legally responsible for. So no more, no less. So in this phase, you're looking at making sure you're getting the proper deductions and the exemptions that you're eligible for, and any other tax planning strategies that might be available to you in order to minimize your taxes. The fifth area is retirement planning, and Lara focused on why this is so important a little in her portion of the presentation. But this is when we're looking at when it's time for you to stop working or to cut back on your hours, how much do you need to have saved? So you're really looking at when you're going to retire, how much you'll need, how long you will need it based on estimates of life expectancy, and what are the vehicles that you will need for that. So that might include Social Security, pensions, and even in some cases, looking at the possibility of reverse mortgages. Finally, the sixth step is estate planning or legacy planning. So how do you want to leave things when you're no longer here? Do you want to leave a legacy to loved ones or any sort of charity? You want to have your wills in place, certain documents that would dictate how you want your estate handled. So living will, power of attorney, and those sorts of things. Next, now that we've gone over the various areas of financial planning, what is the process of financial planning? And again, there are about 6 steps that are commonly involved in the financial planning process. The first is establishing the relationship with the planner and identifying your goals. So here the planner will go over the various roles and responsibilities, outline the expectations, how they're compensated, and then this is sort of the courting phase. You will, make sure that there's the fit and chemistry, and then begin to share with your planner what are your goals and objectives, what are you trying to accomplish. In the second stage of the process is what we're calling information gathering. So here your planner is going to tell you, based on your goals, what information you need to provide to them in order to review and analyze your plan. So it might be copies of bank statements, credit card bills, loans, your retirement accounts, any investment accounts, prior tax returns, those sorts of things. Third is analyzing the information. So now that you and your planner have agreed on the relationship, you've provided the information that they need, they will then take that information and begin to comb through it and analyze it in order to make the proper recommendations based on what you've stated that you need, that you want to accomplish. And fourth is developing a plan. So what are the recommendations? And here you want to look at it as if, as a client, remember, you're always in the driver's seat, so you maintain that control. You can look at your planner as the GPS. So just as you put in where you're trying to get to in the GPS, you always have the option to reroute or go a different way. So you're in constant dialogue with your planner. You determine what you're going to implement and not, and your planner will work with you through that. So they're going to use their experience and best understanding of how to get to your goals and how to reach your goals and objectives. Then you'll look at, once you've agreed on the recommendations, now it gets to implementation. So this is where, the work on execution comes into play. Some things may be implemented very quickly, such as paying off a bill, and other things may take longer. Again, the retirement planning process is a stage and certainly take some time. Finally is monitoring the plan. So just like with anything, it's not a set it and forget it. As life changes, you will have to go back and make adjustments. So if you change jobs, if you get married, have a child, have a windfall, all of those things would need to be adjusted. So you always want to make sure that your plan is appropriate for whatever stage you are in life. So at a minimum, you want to review your plan at least once a year with your planner. Next, we talk about what are the benefits of financial planning, and there are a number of benefits. So I'm just going to cover a few in this slide. The first is working with a professional to help you set realistic goals. So you look at your planner as your coach. So if you have a goal, your planner is going to be there to give you that objective advice to make sure that you're on the right track and that you are setting realistic goals. Second is to eliminate the pressure of having to do it yourself. You know, if you have, just an anxiety about dealing with money or working through your finances, your planner will help you do that. And certainly in areas that you may not have a certain level of expertise, your planner is there to assist you. Next is getting your financial house in order. There's a lot to be said about that. And now that we're coming up to the end of the year and going into the new year, we'll have a lot of resolutions, and many of the top resolutions are, in addition to, losing weight or getting in better physical health, is taking a look at your finances. So this gives you great peace of mind knowing that you're on the right track or know what you need to do to get on the right track. Helping to manage life events. So whether it's the birth of a child, a new job, a divorce, or windfall, your planner will help you with that process. And you also look at planning and working with your planner as something that's long-term. So you typically, once you establish the relationship, will work with them throughout your life. And then finally is that increased confidence. So you're also learning about the various aspects of financial planning. So your planner is teaching you as well. So you'll have that added confidence of knowing that you're doing the right thing. Next, we just look at some questions on what you can ask your financial advisor. And this is important because you are going through the process. This is one of the most important relationships with a professional that you'll have in addition to, say, your doctor. And these are some questions that you can ask. What experience do you have? How long have they been in the business? What are their qualifications? What designations? Do they have degrees in financial planning? And, you can verify all of these things. What services do they offer? And be very specific in that. And the planner will have to, tell you whether they will be able to cover all of the areas of financial planning or if they just focus on certain areas. What's their approach to planning? So you want to make sure that you all are in agreement on how the planner goes about their process. What types of clients? Some planners may have minimums in terms of asset size or a certain niche, and you want to know that you are a good fit for them. Will you be the only, will they be the only planner working with you? So some planners may work by themselves and others may have a team, and so you want to know who's on that team and get to know them, how to contact them so that if you need anything, you know who to go to. How will they pay? How will you pay for your services? So there are several different ways of doing that, and you want to be clear, and your financial planning agreement would detail all of that. And if anything changes, that would need to be updated and discussed with you beforehand. And how much do they typically charge? So it might be a flat fee, it could be on an hourly basis, or a percentage of the assets that they're managing for you. Again, this is something that should be discussed in that first stage of the planning process. Do others stand to gain from any advice that you give? So are there any conflicts of interest? They should be very clear in laying those out to you and how they will be handled. And if anything comes up, they would need to tell you that in advance. And finally, have they ever been publicly disciplined? And this is where you can check. There's a website for FINRA, the Financial Industry Regulatory Authority, where you can just check to see if the planner that you are looking to work with has had any disciplinary actions. And that's important that you know as well. And as we finish up, these are some things that you can expect from working with a financial advisor. And I'll just, show them all. First is integrity. You want someone who's honest and trustworthy, that they're giving you objective advice and that they have an ethical responsibility to act in your best interest. Competence, so again, that they have the appropriate level of skill in order to be able to give you advice. Fair treatment, so that they are clearly stating the services that they're providing and what the cost is of that service. diligence, that they are doing the work that they need to in order to fully review any recommendations that they're making to you for any products. Professionalism. Again, making sure that they are qualified to offer the services and have any sort of licenses that they need to in order to provide them. And finally, privacy. So there's an expectation of confidentiality for any information that you share with them. Normally, the only reason why they would not keep that information confidential if they were required by the court of law to do so, or in sharing your information with some other advisor in order to get to the recommendation that they need on your behalf. And finally, this is just a document checklist. So as I stated earlier, what are some of the things that you'll need to provide to your planner? These would typically be a list of some of the documents that you would need to provide depending on what your goals are and what your planner is helping you with. And lastly, if we could, Stevie, you could put up the polling question, the second polling question, which is just gauging your need for a financial advisor. And I know many people have a lot of questions. So what do you think? Do you think that a planner would be beneficial to you, working with a planner? And if you could just take a second to answer that, that would be appreciated. Great. So it looks like most would strongly agree that they would benefit from working with a planner. And there would be information, there are sites that I can provide that can help you find a planner in your area. Again, knowing what questions to ask and being familiar with the process would be helpful. So thank you for your time, and I will turn it over to our next presenter, Lorraine.
Thank you so much, Jocelyn. I really appreciate that. And before we get started, I wanted to mention that I really do appreciate the expertise and insight from Lara and Jocelyn, and I commend them for all of the work that they do for older adult women. So thank you for that as well. So as we move into, one of the things I make mention throughout my 13 years in the reverse mortgage industry, a majority of my past clients have been older adult women. I've also presented to many financial professionals and planners about the home equity conversion, and I'm happy that we're focusing on this area of clientele. I really feel it's imperative that we collectively provide choices to assist older adult women by focusing on sustaining financial longevity and establishing peace of mind. All too often, we see that there's a lot of people that really get very stressed, and it affects them in a physical manner when they have financial issues. So having choices is really important. So for my part of this presentation, bringing up the caboose of this is really to provide some equity options for people in their retirement years, talk a little bit to you about the home equity conversion mortgage background and history, some statutes and how the program works, also very important consumer protections that are put into place in this program to protect the clientele, and what some benefits and strategies that older adult homeowners may be able to utilize this program for. So one of the options is we have options for people. There are a variety of options for older adults as they enter into their retirement years, and also to sustain their financial longevity. We're just going to talk quickly about home sharing, home equity loans, or HELOCs as we call them, people that can sell their existing property, and lastly, the home equity conversion mortgage itself. So basically, when we talk about home sharing, we commonly refer to this as the golden girl type scenario, where older adults can choose to partner up and share expenses in certain facilities to make it easier on them in which to do so and move forward. Then there's also the home equity loan. And basically, a home equity loan process is going to require a homeowner to make repayments to the lender on a monthly basis. There's also term limits, and the home equity loan can be canceled or frozen by the lender. As we saw back in 2008 to 2010, this happened very often to many adult homeowners, depending on the options that they had with their lending institution. But that certainly is a way in which people can utilize equity from their property to liquidate and get some financial assets for whatever their needs might be. We also talk about a HECM, and that stands for Home Equity Conversion Mortgage. So a HECM is a mortgage that allows older adults over the age of 62 to access some of the equity in their property or to purchase a new property and get a reverse mortgage at the same time. The home equity conversion mortgage is similar to a home equity loan, but it also differs from other conventional loans, and it does not have to be repaid to the lender until the home is sold or when the homeowner passes and leaves the home to their heirs. At that point in time, the amount of interest that is borrowed on the money accrues on the program and gets paid for by the home down the road. However, as we talk about a home equity conversion mortgages, some things to be aware of. The loan may become due and payable if the borrower fails to occupy the property as their primary residence. They also have to maintain the property and not let it go into disrepair. Paying taxes and homeowners insurance is important to maintain throughout the life of the loan. And the amount of money that the borrower is going to receive is based on the age of the youngest borrower in the home, the value of the property itself, as well as the product chosen and any interest rate choices that they have as well. So there's a variety of different options that we have for older adult homeowners when we talk to them about this program and see if it's the right program for them. There is a history behind the reverse mortgage program. The reverse mortgage was actually written for the first time in the United States in 1961, and it was for a widow that resided in the state of Maine. However, at that time, after the loan was satisfied by either the borrower selling the property or the home being passed on to heirs, the remaining amount of equity was shared between the borrower and the lender. That made it a little bit less advantageous for the borrower back then, but throughout the number of years following, many studies were done regarding the use of home equity for older adults. In 1980, a gentleman by the name of Ken Sholin from the Wisconsin Board of Aging approached the government and said, this is going to be a great program if we get your involvement in it, right? So basically the government got involved in the late 80s, and through their insight, the program was made apparent by providing financial safeguards that were put into place. The National Reverse Mortgage Lenders Association was formed, and throughout the following years, the industry underwent a dramatic number of changes in order to adhere to the original intent of the program by Congress. So again, having oversight by the federal government made it a very advantageous program to protect the older adult homeowners throughout the country. There are several agencies and associations that we call watchdogs for the industry. One is the Department of Housing and Urban Development, also known as HUD, and they pretty much, I refer to them when I teach loan officers that they are pretty much mom, right? They administer all the programs dealing with the reverse mortgage and its guidelines. They oversee everything, and they make sure everything's running smoothly. Then we have the FHA, which I refer to as DAD, and their purpose is to ensure the reverse mortgage or be there in case of an emergency and kind of come in and take care of things if things go awry. The protection of the insurance is also called mortgage insurance premium, and we discuss this in all of our trainings with loan officers and professionals as well. As we mentioned earlier, the National Reverse Mortgage Lenders Association is a liaison between the lenders and the government and focused on the ethics of reverse mortgages. They also serve as a voice for the industry, as you know, and also has a public affairs center and approaches lenders with making sure that their education is intact. And finally, the CFPB, the Consumer Financial Protection Bureau, is an independent agency, but they also are responsible for protection in the financial sector, which does include the mortgage industry as well. When we talk about insurance and safeguards for older adult homeowners, one of the things that's really important is to recognize when the government first got involved in reverse mortgages, they developed what's called the NHA, or National Housing Act. And in 1987, it indicated that it required a guarantee to borrowers that they would be protected against the disappearance of their lender or obligations beyond the value of the home at the sale. That fund is now referred to as the Mutual Mortgage Insurance Fund. And also, too, basically what happens is within the closing costs of the program, there's special insurance to protect the older adult homeowner, which is different than in the conventional mortgage world where there's PMI, which is there to protect the lender. And through the NHA, we basically, everything that we've done in this industry has circled back to make sure that we consistently have safeguards in place to protect the homeowner. So this mortgage insurance premium is just one of the safeguards in which to do so. So who's eligible for this program? And in order to be eligible for a home equity conversion mortgage, all of the borrowers on title must be at least 62 years of age or older, have a valid Social Security number. They have to be the primary borrower, which indicates that they have to live in the property at least most of the time, not necessarily 12 consecutive months out of the year, but most of the time, and it's considered that obviously their primary residence. And in addition, they have to maintain their homeowner's insurance and property taxes. But even more importantly, too, is they have to receive counseling by a third-party agency. And what they do is they basically review the options with the older adult homeowner to ensure that they understand the home equity conversion program and all the other options that they have from a financial standpoint, especially going over their budget and expenses and what Jocelyn had mentioned earlier, if they need to be referred to a financial professional, et cetera, that third-party counseling gets involved in that as well. So when we talk about what eligible properties, if somebody was interested in getting a home equity conversion mortgage, we do have them made available for newer existing single-family homes, or if there's a 2 to 4 unit property, as long as the homeowner lives in one of the units there, they can get a reverse on that. Also, FHA-approved condominiums and certain manufactured properties that meet government standards. There are some properties that are not eligible for reverse mortgages at this point in time, and these are indicated on here. So importantly, we have properties that have more than 49% of commercial use, co-ops, bed and breakfasts, single-wide manufactured homes and things of that nature are not currently eligible for this home equity conversion program. So we have different types of home equity conversion mortgages. One is, and it's actually quite simple as compared to conventional loans when there's so many different products out there, it can be very confusing. In the HECM world, we have a fixed rate HECM, and basically that provides homeowners with a fixed interest rate, and it allows them to take their disbursement only at closing. So whatever amount of money they're eligible to receive through the program would be given to them at closing. They really don't have any other options other than that to take whatever's available. Apparently, on the opposite end of the spectrum is what's an adjustable rate reverse mortgage, and that allows homeowners to take flexibility in the amount of equity that's available to them. They can have either a line of credit, which is similar to a home equity loan line of credit, except that amount of line of credit is accessible to them whenever they want. It also grows while it's in that credit line, becoming more available equity to the borrower as time goes on. We talk a little bit about that later in a strategy. We also have an opportunity for people to get what's called a tenure payment. So they can get a monthly payment to subsidize their income for their lifetime, up to 150 years old actually, and it allows them with a set amount of money as long as they live in their property. There are some homeowners that are looking for a higher amount of monthly income because of taking care of needs, such as home health care and things of that nature. So we can put what's called a term payment together, which allows them a certain amount of money for a set period of time. And once that's done, the loan is still not due and payable by the borrower. However, they won't get any continued payments out of that. And lastly, you can certainly have a combination of all of these types of flexible programs on an adjustable rate HECM. Another product that's available in the marketplace and overseen by the federal government is called HECM for Purchase. And this is where a homeowner can purchase a brand new property or an existing property and get a reverse mortgage at the same time. It allows people to either downsize, right-size, or be in a situation where they're in a 55-plus community or move closer to family members. So basically, our builders and real estate agents are very, very prominent in utilizing this program because it allows their older adult clients to be able to utilize the purchase and thereby get into a new property without incurring a monthly mortgage payment, such as on a conventional loan. And it really creates for some flexibility and increased choices post-retirement instead of making people feel that they have to stay in their current residence if they don't want to and age in place wherever they'd like to go. So that program came about in 2008, and it is also overseen by the government, such as the regular home equity conversion mortgage for refinances. So there's a lot of consumer protections put into place within this program. So as we mentioned before, there's mandatory third-party counseling. The borrower or anyone living in the property needs to visit a counselor or by telephone and have a session, and that counseling certificate is mandatory for us to be able to move forward and provide the program and move forward with the services and appraisals and things of that nature. There's also HUD-approved agencies, and they are required, these counseling agencies have to go through continuing education credits. They have to take an exam before HUD will approve them to provide counseling to older adult homeowners. And as I mentioned before, they have to issue a certificate before anything can be moved forward from the lender or broker standpoint. Also, too, the mortgage insurance premium. And basically that insurance is paid for through the closing costs of the program. It's financed into the loan, and it's also a part of the interest rate, which is a low interest rate, that grows on the money that's been borrowed. That's added to the balance as well for continual protection should the value of the property ever exceed, or the loan balance, ever exceed the property value, or in case of a disappearance of any lender, the homeowner is always protected, as is their equity because of the program. And as I mentioned before, it's similar to PMI for protection on lenders. However, this is a protection for the older adult homeowner. So here's a couple strategies, and I'm going to ad-lib through them. And as Steve mentioned, all of you will have copies of the slides here, and I really urge you to take a look at these strategies a little more diligently if you're interested in learning more about it. Long-term care, and obviously, believe it or not, long-term care insurance or long-term care needs are going to be utilized more diligently than any other insurance out there. And yet, it's the least that is used by homeowners, okay? Because this could be expensive. The older you are, the more expensive it gets. But long-term care means a variety of different things. And as Jocelyn and Lara alluded to earlier, the need to plan ahead is really important. And because of that, sometimes home equity conversion mortgages allow homeowners to utilize some of their equity to prepare for long-term care, whatever that might mean to them in the long run, or for their loved ones, that they want to keep their home, their loved ones in their home being taken care of as opposed to going to a facility and so on. Another strategy also, too, that is used on the home equity conversion mortgages really references, as I mentioned before, purchasing a new property, right? So there's a lot of folks, especially in our boomer generation, that indicate that they would like to move to a different location. And the HECM purchase program enables borrowers to do that. Again, it's used the same way as a traditional reverse mortgage with the same types of interest rates and programs as well. However, through a little bit of a contribution towards the purchase of the property on behalf of the homeowner, the remaining balance can be financed into a home equity conversion mortgage, so the borrower does not have to make a monthly payment as long, again, as they live in that new property that they've moved into. Another strategy is Social Security planning. We have a lot of people that wish to retire at a certain age. However, they are not able to get the maximum amount of their Social Security benefits. Home equity conversion mortgages have been able to provide people with monthly incomes to subsidize the difference between when they are a younger retiree as opposed to when they wait until they're of a certain age to get their maximum Social Security benefit. So on the screen here is just an example of someone that is eligible for over $2,000 a month in their benefits but when they become 70, it grows to $3,200 and change. So therefore, instead of waiting till 70 to retire, they can utilize a home equity conversion mortgage to supplement the difference. And then when they become of age, they'll get that increased amount of Social Security. So that's another strategy when it comes to estate planning for older adult homeowners. The next is fixed income planning, and again, as I mentioned before, there are customers that either would look to purchase an annuity or get involved in things of that nature. With a reverse or a home equity conversion mortgage, that can leverage the equity so they can save their actual cash, and it gives them a line of credit option. They can take money from their line of credit whenever they want to. That credit line, as I mentioned earlier, this is one of the big factors, especially when we deal with business professionals such as financial advisors and elder care attorneys. The line of credit will always increase regardless of the value of the property. And again, even if the property doesn't increase in value a dime, the credit line or opportunity for utilization of equity will always grow for the borrower. So it's a great opportunity for people to be able to tap into that as opposed to other items which might not be as advantageous depending on what they're looking for. When we talk about the line of credit, I just really mentioned a little bit about that, but because it's similar to a home equity loan, one of the things that we want to make sure that people understand is, these line of credits, not only do they grow regardless, but they never get frozen, and if a borrower chooses to make a prepayment back to it, then what will happen is it goes right back into the line of credit, and again, becomes additional equity to grab as needed when time comes. So the line of credit option is very, very prominent in the financial world, and a lot of our older adult homeowners that have enough equity to have a credit line have really used this option, and I'm a big proponent of that as well. I teach it quite often as probably being one of the greatest advantages of a home equity conversion mortgage that's out there. Another option is we call it diversify real estate holdings, and in this example, which you can read at your leisure, it provides an opportunity for an older adult homeowner who is looking to purchase another property. And by doing a home equity conversion mortgage on her current property, she's able to withdraw a certain amount of equity out of her home and be able to utilize that to purchase another property and free and clear cash and not have a mortgage payment on either home. So again, there's a lot of different ways that people can use the home equity conversion mortgage to be able to enhance and manage their wealth and sustain financial longevity. It's very important, as Jocelyn mentioned, to have a financial plan in place and not to wait until you're 75 or 80 to start thinking about what you want to do to sustain that and to be able to be comfortable. Many people that retire at age 65 have such an opportunity to live at least another 20 years. We want to make sure that they have the ability to have financial resources available for them for a variety of different reasons. And again, utilizing home equity is certainly an option that they have. They do play a vital role in retirement planning these days, and as I mentioned, not really saving people from the frying pan, but really providing a strategic way to be able to plan ahead and do estate planning and manage wealth and have these strategies available at their young 60s or even earlier, so that way they can really prevent getting into a situation that's going to be a disadvantage for them as they age, and especially for women spending a very long time, as Lara was mentioning, 15 years or longer, living alone. This is certainly a vital role to be able to have them utilized as well. So lastly, our industry has helped, literally just this year, we hit the 1 million mark. Since 1989, there have been 1 million reverse mortgages funded in the United States, and they provided older adult homeowners to use equity, have financial peace of mind, establish some wealth management strategy tools so they can age in place, age comfortably, age happily, and really reduce the amount of stress that is referenced from financial difficulties as we get older. So hopefully any of the clients that other people have, they can at least provide this option to them as well. So with that, I would like to launch our final polling question, please, to Steve, if you could, to our students and help people attending. All right, so all of the following are consumer protections associated with the home equity conversion mortgage, except which one? I'll give you about 10 to 15 seconds to fill that out. Thank you, guys. All right, let's see how they answered. Okay, all right. Well, those of you that indicated reduced interest on HECM products, you were correct, so 39% of you got it right. Mortgage insurance is a consumer protection, counseling, and financial assessment is indicating we're checking to make sure that homeowners can pay their homeowners insurance and taxes, so that's a consumer protection against as well. So those of you that answered number 2 were correct. So I thank you very much for your time and your attention, and I appreciate it. Back to you, Steve.
Right. Thanks very much, everyone. Great presentation, presenters. Thank you so much. It is time for the Q&A portion, everyone. So if you want to send in your questions for what we've been talking about here, please feel free to do so at this time, and we will pose those questions to our presenters here. The first one here, presenters, can Jocelyn please explain the difference between an investment broker and a financial advisor? Some brokers portray themselves as offering broader planning services than they are actually qualified to provide.
Sure, good question. So an investment broker or stockbroker is really just going to manage your investments, and that's their lane, so to speak, whereas the financial planner is going to be able to touch on the different areas that I talked about in the presentation. So they would have some familiarity with each of those stages, and they may specialize in one area, but that's really the difference. An investment broker is just going to handle your investments, and that's the lane that they should represent themselves as being having a specialty in.
Okay, perfect. Well, we've been talking a lot about planning here, so the next question involves that. It's kind of the standard default for people to put some things like this off. We know it is important to plan for the future, but it always seems like we'll take care of it tomorrow, next week, and then before we know it, it is next week, and we're kind of in a hole. So when you're working with your clients, how do you express to them and kind of get over that initial resistance of planning for the future and communicate to them that it is a really important thing that they have to think about, and talk about a little bit how you overcome that sort of natural built-in resistance that people have to thinking and planning about things like this, especially when it involves death, of your own death, the death of a spouse, things like that.
Well, this is Lara.
Go ahead, Lara.
No, go ahead. All right, I'll get us started, and then you can jump in. Yeah, I would just say that when we're working in our workshops with women, it's overwhelming, and I think it's overwhelming for all of us. I don't think anybody, even professionals in this area, really love to just sit down and hammer through their retirement planning. And so I think one of the things that we really try and emphasize is just sort of taking those small steps. So when you walk away from this webinar, or if you sit down and you're like, oh my gosh, I don't know where to begin, come up with sort of those, like, well, what are the 3 next action steps I can take? What are 3 things I can set as goals to do and to get done? And then, focus on getting those done, say, within the next month or the next, 3 months, whatever it is. Give yourself a deadline, and then sort of build from there. I mean, I think just kind of having to really break it down to small steps, and don't feel too pressured to have to do it all at once. It's hard to tackle it all at once, and so I think just sort of small goals, small steps, and then before you know it, those steps really add up, and you're kind of on your way in planning.
I agree, Lara, and I always tell, would say to clients that this is a marathon, not a sprint. So it's not something that's going to be accomplished overnight, and not to be full of cliches, but saying that, or how do you eat an elephant one bite at a time? So just going through, making sure that you're being consistent in getting to the steps that you need to, and you will get there.
Okay. Do you have any tips on having a conversation with your parents about all of this?
That's a really challenging one.
I talk to my clients because for many of my clients, they may be that go-to child who is sort of the family ATM. So if there were a situation with their parent, they would likely be the ones to step in and take care of them. So I talk to my clients in that they need to be aware of their parents' financial situation because it's going to impact them in their retirement and long-term planning. And while it's sort of a turning of the tables where the child now steps into that parent role, but it's important that they have the conversation. It's not to be intrusive, but just that you're telling your parents that you want to make sure that they have a comfortable retirement and that you want to be sure that things are in place as they need to. So if you approach it that way and not to be judgmental, because some parents may be resistant if they know that they haven't done the proper planning that they need to. So, they might be reluctant to share that. But even if it's having, another planner or a third party come in to get that dialogue, it's helpful because you do need to have those conversations because you don't want to be caught off guard if an illness happens or, long-term care or when they do pass away. So it's in their best interest that they would have those conversations.
Right. Well, we have just about reached the end of our hour here, and before we wrap it up, I just wanted to check with our presenters here, see if you had any closing remarks or anything you want to say before we wrap up today.
Well, this is Lara. I just, again, want to thank everyone for joining us today, and I guess I would just sort of echo some of what I was saying before, is that, hopefully everyone can kind of walk away and be thinking about, one or two things that they can do to sort of help improve wherever they are in their financial journey, but then also sharing this information with other people. Like I said, the more we can be talking about this together, I think the better we'll all be.
Okay. Well, it is just about time for us to wrap up here, everyone, and I want to thank you for joining us for today's webinar. I want to thank our presenters today, Lara Hinz, Lorraine Geraci, and Jocelyn Wright, as well as Jenny Werwa at the beginning of the hour. We want to thank our sponsors for today's webinar, the National Reverse Mortgage Lenders Association. We really want to thank them for partnering with us for today's presentation. We're really excited about that. Again, we want to thank you for joining today's webinar, everybody, and have a great weekend.
Thank you.
Thank you. Take care.